In Learning Objective 7, we're going to be going into Appendix 6A, and what I'd like to do here is go over the periodic inventory system and compare it to the perpetual system. And, we pretty much have been emphasizing the perpetual system. Periodic system is interesting. It can be used for external reporting. As I said, it doesn't make much sense to use this to control inventory because you have to wait until the end of the period before you have any information on ending inventory and cost of goods sold. Now, again, the alternative approach to perpetual is periodic, and periodic is a lot easier. It's not as tedious. You don't have to record cost of goods sold and gross profit after each sale. Even if it's automated, nonetheless, you do lose information. Periodically, you would calculate and you would count ending inventory and then calculate cost of goods sold, but there's a lack of information in between each period, which could be a month or a year, and therefore it is very difficult to control inventory, and manage the business. So when we do use the periodic system, we start each month with, of course, the beginning inventory. And as we said, we already covered some of this in the chapter. When we buy inventory, we record it in a purchase account. And we know that that is the sum is called the goods available for sale. Goods available for sale. And of course, we do not record any adjustment to inventory or cost of goods sold when we have an actual sale. What I want to emphasize, of course, is that purchases would be net purchases, and that would be net of sales returns and allowances. And of course, purchase discounts. Now, when we look at the sale, we only record cash and receivables and credit sales. So we debit the cash and receivables and credit sales. We don't affect inventory for the sale. And then at the end of the period, we sort of back into cost of goods sold by taking the goods available for sale and subtracting out the ending inventory to get the cost of goods sold. So the standard cost of goods sold formula, which you could pretty much use anywhere, but it is a standard for the periodic inventory system. Again, the inventory, is not monitored. It's not tracked continuously. So you only are able to make this calculation at the end of a particular period. And of course, this is due to, the fact that ending inventory is not known unless you take a physical count at the end of that period. The beginning inventory, of course, is carried from the end of the prior period. Purchases, of course, are known, accumulate during the period, and we have the net purchases. And the ending inventory balance, of course, is then subtracted from the goods available for sale to get the cost of goods sold. So with this framework or this review, now let's take a look at the three cost flow assumptions. We're not going to worry about specific identification because that would be identical whether you had periodic or perpetual. So let's now look at the effects of using a periodic inventory system. And we're going to go back to a similar or a common example that we've been using for Smart Touch throughout this chapter. And once again, we start the inventory, we start the period, the month of August, with 2 units on hand. It costs us $350. We buy 4 units at $360. We sell 4 units, which leaves us 2 units left. Then we buy another 12 units for $380, and then we sell 10. Under FIFO, if we were calculating this ending inventory, and I'm going to go back for a moment, we would first of all note that the beginning inventory, so let's go back here, beginning inventory is going to be 2 units at $350. We're now going to take our purchases together. So we're going to take the 4 units at $360 plus the 12 units at $380. And we know that from this example, from doing this earlier, we know that we had 6,000 in purchases, and we also started the year with the 700 in the beginning inventory. So we know that the cost of the purchase of 4 units is going to be $1,440 because we paid $360 each, and we bought 12 units. Okay, so we bought 12 units at a cost of $380. And that would have been for a total of $4,560. So the total cost of goods purchased is $6,000. Now, there were no purchase returns and allowances and no purchase discounts in our prior example. And we know that the beginning inventory is 700. Now, if this is FIFO, the first goods in are the first goods to be sold. So therefore, everything that you had at the beginning of the period plus your purchases have been sold except for 4 units. Now, the way this works is very different than the perpetual system. Under the perpetual system, if you sold 4 units, well, some of that would come out of beginning and some would come out of the purchase. Periodic, we wait till the end of the month. So basically what would happen is that we would say that we have the beginning inventory. Let's just do this in units. 2 units. We have purchases of 16 units. And we have the available units of 18. And out of those units, the beginning inventory, we sold 14. So the first one's in and the first one's out. We sold 2 from beginning inventory. And we also sold another 12. If we sold a total of 14 units, we sold another 12 from our purchases. So that means that our ending inventory is going to be 4 units, as we see here. Now, where do those units come from? Well, under the FIFO assumption, the beginning inventory was sold. All of this purchase was sold. And that's already 6 units. And that means that out of the units that and again, we sold 14 units in total. So if we sold 2 units from the beginning inventory, 4 units from the first purchase, that's 6. So we have 14 units sold in total. We've accounted for 6 units. There's 8 units that we've sold. They must have come out of the 12 units purchased. So if you sold 8 out of those 12, that's where you get your ending inventory. Most recent cost, and that's going to be at $380. So our ending inventory under a periodic system, even though I'm looking at a perpetual record, would be the 4 units times 380. And that would give me an ending inventory of $1,520. So putting this in the cost of goods sold formula, we know that beginning inventory was 700. I already showed you the purchases of 6,000. Goods available for sale, 67. Ending inventory, again under FIFO, is the most recent cost, and therefore the oldest cost is in the cost of goods sold. Moving to LIFO, and we're going to compare this in a moment, and I just wanted to point something else out. You should go back and check, but I'm going to tell you that even though this is, I'll tell you this now, even though this is periodic, the results are exactly the same as perpetual. So FIFO periodic and FIFO perpetual give the same results, and that's because FIFO is naturally a perpetual cost flow. LIFO, however, is going to be a little bit different. The LIFO basis is going to be significantly different than the approach under perpetual. So LIFO periodic is going to be different. And in this case, if we go back, we know we have 4 units left in ending inventory. And we know that under LIFO, the last goods in are the first ones out, and the ending inventory is the oldest units. So that means that out of the 4 units, you probably can see this very easily, that ending inventory under LIFO is going to be the oldest cost. And therefore, if the last one's in and the first one's out, that means you've got 2 units left at $350. And you have another 2 units, right? So you're going to have another 2 units left. And those 2 units will be coming from the batch of 360. So you have 720, and your ending inventory is going to be 1420. Now, it's interesting that you're including in ending inventory units that have actually been sold. And the reason why the periodic LIFO can do this is because they wait until the end of the period to come up with the ending inventory value. So looking at LIFO again, we know the beginning inventory was 700. We go back to our purchases of 6,000 that we know, and the ending inventory, 4 units, 2 at the oldest cost and 2 at the next oldest cost. Once again, ending inventory is the oldest, cost of goods sold will be the most recent. And finally, in a periodic inventory system, under the weighted average approach, we know that the inventory is going to be calculated at an average cost, which is equal to the ratio of the cost of goods available for sale over the number of units available. The difference between periodic and perpetual is that under periodic, that average is only taken at the end of the year, rather than at each point of purchase. So remember, under perpetual, the inventory is, or the average cost of inventory under perpetual is calculated at each purchase. Here, periodic, it is computed only at the end of the period. So the weighted average cost, again, is calculated at the end of the period as the ratio of cost of goods available for sale over the number of units available. So if we look at the inventory under a periodic weighted average, we're going to wait until the end of the year and take the ratio of the cost of goods available for sale divided by the number of units available. And the average cost is $372.22. So that's your average cost for the period. And then, of course, applying this average at the end of the period is going to, number one, start with the beginning inventory at the average cost at that point. Purchases, again, we don't take an average there because we don't take the average until the next period and then, or the end of the period. So we don't take an average cost every time we have a purchase. So this would be somewhat different in terms of the average cost would change here. Here, the average cost doesn't change. Of course, in either case, periodic versus perpetual, your total cost of goods available is going to be 67. But now, ending inventory is 4 units at $372.22, and your cost of goods sold is $5,211, and that becomes the average cost under a periodic basis. So once again, it's going to be a situation where you will get a different result under periodic LIFO and periodic weighted average, but you would get the same results under the FIFO basis. And the reason why the results are the same under the FIFO basis is because there is a natural cost flow. So if we wanted to, let's just go back and compare this. Let's start back at FIFO. If we go back and if we look at our earlier learning objective, so if you go back to an earlier module, and that module is Module 2 or Learning Objective 2. And if we take a look at perpetual FIFO, the ending inventory under perpetual FIFO is going to be exactly the same. So that the cost of goods sold, this is periodic, under perpetual, the ending inventory and cost of goods sold are the same. So FIFO perpetual and FIFO periodic are exactly the same. And that is because the FIFO basis is a natural perpetual cost flow. Now there will be differences with perpetual LIFO and perpetual weighted average. So let's go to LIFO next, and this is periodic LIFO. Let me put the perpetual here. If you go back to Module 2 and compare this, you're going to find out that cost of goods sold was $52.40 and ending inventory was $14.60. So it's not the same. So LIFO perpetual does not give you the same results as LIFO periodic. And the difference is because we wait until the end of the period to calculate cost of goods sold in the LIFO basis and ending inventory, whereas perpetual, it's calculated after each sale. Cost of goods sold is calculated after each sale. And finally, if we go to the weighted average, we're going to find out that we get differences as well. So if we look at, again, go back to Module 2, and you'll be able to determine the weighted average under the perpetual. You'll be able to see that under the weighted average basis. Here is the periodic, perpetual, again, it's weighted average. Under weighted average periodic, the ending inventory is going to be $14.89, and under periodic weighted average, the cost of goods sold is $5,211. Under the perpetual basis, if you go back to Module 2, you're going to find out the ending inventory was $1,507. And the ending inventory, the cost of goods sold was $5,193. Now, of course, equal to 67 in both, but notice the differences. And the difference is due to the fact that under weighted average, you have, under periodic, you wait till the end of the year to take the average. Under perpetual, the average is taken, a new average is calculated after each purchase, and it is used to calculate the cost of goods sold for each sale. So to go to the whiteboard, just to summarize, when we're comparing the two methods, under periodic and perpetual, FIFO is the same. LIFO and average cost will have different results. So again, just to review the periodic system, we wait till the end of the period, and that's why you get these differences for the cost flow assumptions of FIFO and weighted average that aren't a natural perpetual system. FIFO is a natural perpetual system, and as a result, it is going to give the same results whether you use periodic or whether you use the perpetual method.